Crypto sentiment has collapsed. Bitcoin is under pressure. Ethereum is struggling. XRP is trading far below where most investors expected it to be this year. And according to new sentiment data, the crowd is once again declaring crypto dead. But while retail investors are losing confidence, Wall Street banks are building blockchain infrastructure. Congress is moving major crypto legislation forward. Mortgage markets are beginning to touch Bitcoin, and a strategic Bitcoin reserve bill has officially been introduced. The question isn't whether crypto is disappearing. The question is whether the public is becoming bearish at exactly the wrong time. Nothing in this video is financial advice. Always do your own research before making any investment decisions. Welcome back to Ledger Pulse, your source for XRP, Bitcoin, blockchain adoption, tokenization, and the future of global finance. If you're watching this for the first time, hit that subscribe button and join the community. Now let's dive in. One of the most interesting signals in the markets isn't price, it's sentiment. According to data shared by Sentiment, crypto discussions across social media have reached some of their most pessimistic levels in months. Terms like dead, finished, over, gone, ending are suddenly surging again. Historically, these moments tend to appear near major market lows rather than market tops. Why? Because by the time everyone is convinced an asset class is finished, most sellers have already sold. Fear peaks near exhaustion, not necessarily at the exact bottom, but often somewhere close. The last major spike in this type of negativity occurred in mid-February and was followed by a notable rebound across the crypto market. That doesn't guarantee history repeats, but it does show that extreme pessimism has often been a contrarian signal, and right now, pessimism is everywhere. A new CoinShares report revealed something fascinating. During Q1 of 2026, hedge funds reduced their U.S. spot Bitcoin ETF holdings by roughly 39%. Meanwhile, banks more than doubled their exposure. Read that again. Traditional financial institutions increased exposure while many speculative funds reduced theirs. This is an important distinction. Hedge funds often trade shorter-term narratives. Banks build longer-term infrastructure. When banks begin increasing exposure, they typically aren't thinking about next week's price action. They're positioning for future financial systems. And that's exactly what we're seeing unfold. The smart money narrative may not be where most people think it is. While retail sentiment is collapsing, some of the largest banks on earth are reportedly building a shared blockchain network. According to reports, JPMorgan, Citi, and Bank of America are working on infrastructure designed to give bank deposits many of the advantages associated with stablecoins. The goal? Near instant settlement, programmability, and blockchain-based efficiency. The targeted launch window is reportedly around 2027. Think about what this means. For years, banks criticized crypto. Now, they're building technology inspired by it. Not because blockchain failed, but because blockchain worked. The conversation is no longer whether tokenization is coming. The conversation is who controls the rails. And that battle is just beginning. Crypto legislation continues moving through Washington. Recent updates suggest lawmakers are working through remaining concerns surrounding ethics provisions and illicit finance language. While there are still hurdles ahead, the overall message coming from Capitol Hill remains encouraging. Senator Cynthia Lummis recently suggested timelines could extend beyond early expectations, potentially moving closer toward the August congressional recess. That may frustrate investors hoping for immediate action. But the bigger story is that progress continues. For years, the industry asked for regulatory clarity. Now, lawmakers are actively negotiating the details. The process may be slow, but the direction remains clear. And once rules become established, institutional participation becomes much easier. Another development receiving less attention involves crypto taxation. The House Ways and Means Committee is reportedly circulating multiple draft proposals covering de minimis transactions, stablecoins, mining, and staking proceeds. These discussions matter because regulation isn't only about market structure, it's also about usability. Every improvement to tax treatment reduces friction. Every reduction in friction makes adoption easier. And every step toward clarity removes uncertainty for individuals and businesses alike. This is the type of infrastructure development that rarely creates headlines, but can have massive long-term impact. One of the most overlooked stories of the week came from Coinbase. The company announced that the first Fannie Mae-backed mortgage utilizing Bitcoin-related collateral has reportedly been issued. Think about the significance. For years, Bitcoin was viewed primarily as a speculative asset. Now, we're seeing it slowly connect with traditional financial products. This doesn't mean every mortgage will suddenly involve Bitcoin, but it does demonstrate a broader trend. Bitcoin is gradually moving deeper into the existing financial system, and each integration creates another bridge between digital assets and traditional finance. Meanwhile, the strategic Bitcoin reserve conversation continues gaining momentum. Congressman Nick Beggic's strategic Bitcoin reserve legislation has now officially been published. Whether the bill ultimately succeeds or not, the significance is difficult to ignore. A few years ago, the idea of sovereign Bitcoin reserves was considered fringe. Today, lawmakers are debating it openly. Around the world, governments are beginning to explore digital asset strategies, reserve diversification, and blockchain infrastructure. The conversation has evolved dramatically, and that shift alone tells us how far the industry has come. So where does XRP fit into all this? The answer is infrastructure. Look at the common theme connecting every story in today's episode. Banks building blockchain networks, legislators building regulatory frameworks, institutions increasing exposure, tokenization expanding, and settlement systems modernizing. This isn't just about speculation anymore. It's about financial plumbing. The future winners may not simply be the assets with the loudest communities. They may be the networks capable of supporting real-world financial activity at scale. That's the opportunity XRP investors continue watching closely, because if the future becomes tokenized, interoperable, and settlement-focused, infrastructure becomes incredibly valuable. So, while social media declares crypto dead, banks are building, lawmakers are negotiating, institutions are positioning, and blockchain infrastructure continues expanding into traditional finance. The market may be fearful today, but some of the biggest developments often happen when nobody's paying attention. The crowd sees falling prices, the institutions see infrastructure, and eventually, one of them will be proven right. If you enjoyed this episode, hit the like button, subscribe, and share this video with someone following the future of crypto. Thanks for watching, and I'll see you in the next one.